Well, welcome back. It's great to have you back with us, and I am always honored when Daryl and Chris join me for the podcast. And typically, when we do the podcast and these guys join me, we also do a YouTube piece. So it's wonderful to reach out to people who enjoy getting their information through the videos. By the way, if this is your first time here, I'm Paul Merriman, and I started this foundation in 2012 with a commitment to educating investors to teach them how to take better care of their investments, primarily on a do-it-yourself basis. That's the goal. On the other hand, if we feed you some information and you have an advisor, and because of this information, you're able to maybe ask a few questions that might lead to a slightly different portfolio, we're happy for that as well. And with me, if you don't know Chris Pedersen, he's our director of research and a retired engineer, marketing development. How many titles do you have? How many how many lifetimes have you had, Chris?
Oh, I've been a professional photographer, but mostly I was a product manager. So that's it was a great fun career. And then when I got ready to retire, I realized I needed to live off my investments and I needed to learn how to do that better. And so I called you and volunteered to try and help, and it's led to a much more comfortable, much more knowledgeable retirement. And
That's
and I
great.
should point out, you're too humble. You mentioned that you founded this, that you created this foundation. You did this all with your own money. There is no conflict of interest. You don't earn money from anybody or ask anybody for money or work for money. You do this out of the goodness of your heart and just with a desire to help people. And that was part of what attracted me to join you.
And then for thank you, that is very kind. Just for full disclosure, we actually do have people who donate money to us, and we're thankful for that. But most, yes, most of the money has come out of my wife's and my pocket, and but we do have a lot of very kind contributors. And Daryl, you were an engineer, a manager most of your career.
I was an engineer for all of my working life career, essentially. Started out as a system engineer. Started out as an astrodynamicist. That's the one who works with orbital mechanics. Um, Became a system engineer later on, and then retired and talked to you about coming and trying to help pick up some slack when one of the people who had been supporting had to leave the foundation for other reasons. And so that was, I don't know, 10 years ago, eight
Yeah,
years ago, something like that.
amazing. But
So
you guys have
it's
done an amazing job of helping our folks, and uh, it takes a lot more than money to make this work, and you guys have made it work, and I do appreciate it. Now, today is kind of a Q&A day, and uh, I've got a bunch of topics. The first one that I'd like to cover has to do with that amazing day, and I'm not going to get into politics, but we had a political event that led to the stock market deciding to go up 3, 4, 5, 6, 7%, depending on what investments that you had. And it just opened the door for me to look inside some of the investments that we recommend. And of course, we're big on small cap value as a way to add some juice to your portfolio. And I'm going to share a few numbers, and then I'm going to turn to Chris and find out how meaningful these numbers are. Now, if we just talk about that one day, that would be November 6th. AVUV, Avantis Small Cap Value, was up 7.2%. Now, another fund that is managed in a very similar fashion, managed by dimensional funds, was up 7%. And that's interesting because if you look at these two funds when they've both been in existence, their returns have been very close because the people who started at Avantis, who started the Avantis funds, used to be at Dimensional Funds. So it's not shocking that these two funds have produced very similar returns on that one day. But if you wanted to be in the hot dog of them all, amongst the funds that we track in that arena, VBR, that's a Vanguard small cap. By the way, this is a small cap value fund that has larger companies on average. It was up over 9% in one day. And then VIOV up 5.8 and VTWV, that's another Vanguard small cap fund, up 6.3. So I am sure that the owners of all of those funds were happy to own them on that single day. They probably haven't been all that happy every day over the last years because value has lagged growth generally. But here's what I want to dig into. I want to dig into the fact that for the last 5 years, AVUV has compounded at 14.5%, VIOV at 9.9, VBR at 11.9, VTWV at 9.8. So AVUV has way outperformed over this particular 5-year period. If you actually put that money to work and you look at the Morningstar graphs, it would show that you'd be up about 93% in AVUV and as little as 42% at VTWV, and then the other two are in between. So here's what when I say I'm worried about it or that I'm concerned about it, I just want to know, is it legitimate that AVUV could in fact continue to outperform, maybe by not this much? That would be unlikely because that's a huge difference, but by enough that it could be life-changing for some people. So, Chris, you have turned these kinds of investments inside out between Morningstar and what's the other source that you use so much of?
Portfolio visualizer.
Yes, of course. What do you know? What can you tell us about these funds that would lead us to believe that this is either just a fluke or there's some meat here that we want to have on the bones of our portfolio?
Well, as investors in these smaller, out of favor companies, what we're looking for is their future earnings growth. We're looking for them to thrive and grow, and when we buy a fund that includes them, we're looking for stable exposure to companies of a smaller size, companies of a greater discount. And we want that to be stable over time. And if it is stable over time, we would expect that there will be periods of time when those attributes are worth something more than just exposure to the market at large. And there'll be times when they're not. And hopefully it averages out over the long haul to look like the past. And the past says that those smaller companies and those value companies delivered higher returns with a little bit more volatility. And so it's interesting you started all of this with a discussion of one day of returns, because we'd all agree one day of returns isn't important, but what that 1 day of returns probably says is that people believe that the future, based on the information that we've gained in the last few days, is more favorable to companies that are small, to companies that are out of favor. And we're not pundits, but pundits on the news would tell you why. They would say, oh, it's because there's going to be less regulation, and in a deregulated environment that favors these startups that are trying to do innovative things, or the tax regime will be better, or whatever. And the truth is, they don't know either. They're just guessing. But the consensus of the market yesterday was obviously that these companies are going to do better, that companies with these attributes are going to have better earnings growth, and that earnings growth may be less discounted because of interest rates and inflation than it was the day before. So that's the belief of the market. Now, you asked, is it reasonable to expect that AVUV's advantage is going to continue into the future? And that depends on two things. It depends on whether the fund is managed in a systematic way so that its exposure to these attributes that give us higher expected returns is stable. And the answer to that question is generally yes. You can go into Portfolio Visualizer and you can run a regression analysis on it, and you can look at the residuals. It's basically a chart that shows you how close the model is to modeling the returns and how much exposure you get to each of these attributes over time. And it's very stable. You can also just do a shortcut and go look at the R squared number, which says how good is the model? Did the model predict returns pretty accurately for when they came in based on what the market was doing in the small part of the market and the value part of the market? And I think the last time I looked, it was 98%, which is pretty high. Yeah. So I think it's reasonable to expect that AVUV will continue to give you exposure to these attributes in the way that it's done in the past. And that has been advantaged exposure over VBR, over VTWV. It's why it's my best-in-class recommendation, is that it gives you more of the sauce, the flavor under the hood that's going to spice your portfolio. Now, whether that means next year it's going to perform well or not, though, depends on whether those attributes are being rewarded at that point in time. And we hope that over the long term, over 5 years, 10 years, 15 years, that those attributes will look like they did in the past. And that means that they do come in and out of favor, but that on average, they're to our advantage. So I'm optimistic. I'm optimistic about AVUV. I think it's going to continue to be a good best-in-class choice for us. The DFA funds you mentioned are not far back. They're actually neck and neck. So in terms of the best-in-class choices, one of the things I aspire to do next year is to show not just which one's best, but how far apart they are, some kind of a relative ranking so that people can see, because the two are much of a muchness. They're actually very close to one another. And if somebody's already in one and has to realize profit and gains to switch to another one, it probably doesn't make sense if they're close. If there's a big difference, then it may make sense. And that's what I hope to be able to reflect in the update.
Talk a little bit, Chris, about let's call it quality. You had a slightly different way of the term about quality, but the difference in quality of the Avantis companies that they hold, and for example, the Vanguard WTWV and I think VIOV are both basically Russell 2000 based indexes. What were those differences between the Russell 2000 and Avantis that gave Avantis theoretically an upper hand?
Well, regarding quality, the specific attribute that shows up in the regressions, this is the Fama French 5-factor regressions, is rich minus weak. So these are companies with advantaged financials, and the rich minus weak advantage, or the quality advantage, if you will, was uh, 10 or 20 basis points, 10 or 20% of that attribute or that factor when you compared these funds. And so that means that you have an engine that's firing on more cylinders. It's just the more broadly you are exposed to a wider range of these attributes, these factors, as the academics call them, in your portfolio, the more consistently that portfolio will perform, because each of these attributes tends to come in and out of favor at different points in time. And the more you get, also the higher your expected return. So there's a number of reasons why AVUV should do better, but again, in any given year,
Yeah.
you don't know, right?
So I know, looking at Morningstar, that AVUV has a lower PE ratio, average PE ratio. I notice that at Morningstar that the price to book ratio is lower for Avantis. The size is not too different, actually, with AVUV, VIOV, and VTWV. So it's not a size factor difference that has driven this this difference in returns. Um, so I appreciate all that you just said. I will add something that might be an advantage in terms of knowledge. I don't know that I've read this before on one of our podcasts, but a fellow that works at Avantis, who I've known for uh, 20 plus years, I knew him when he worked at DFA, and his father was actually responsible for helping our firm become a DFA advisor in 1994. So I know this young man well, and I have great regard for his commitment to doing the right thing. But he provided this. He says, our strategies, this is from somebody who works at AVUV, our strategies are daily managed, by the way, to maintain exposure to the target universe. We are designed to provide exposure to the top 25% of the small cap universe that are highest in the joint ranking of profitability and modified book to price. Essentially, we are looking to own the most profitable business that are also trading at the low valuations. We are less concerned about what industry the companies are in. We just want businesses with great profitability at a good price. With that said, we have some constraints to prevent significant sector concentration. We have top line cap of 30% in a sector. We also have a relative cap of 10% of anything that would bigger than 10% of the small cap universe. We don't buy REITs because we view REITs as a distinct asset class, and we want clients to be able to choose REITs if they want real estate and how much they want. He mentions that they have a global REIT strategy. We also don't buy utilities in the Avantis value strategies because they tend to be highly regulated, which has a negative effect on long-term expected return. These exclusions will also impact relative sector weightings. So you mentioned, Chris, looking for a system. And what confuses some people is they think that Avantis is looking for the best companies. Well, and where you measure the management and you measure the financials and all of those things. And basically what they're looking for is a company with good financials that's underpriced. Would you make it any more complex than that?
Well, and they're looking in the small part of the market
Yes,
where
yes,
there are a lot of companies. It's it's not like the S&P 500 where you got 500 companies that everybody on the planet's looking at them. When
yeah,
you get down into the small part of the market, you have thousands of companies that are less well examined, and and the fact that they do this so systematically, they do it very systematically, means that in many respects they are like an index. Because and people do sometimes trip over this and say, well, Avantis is active, they're not passive. Well, the S&P 500 is decided by a committee, that's active as well.
right.
So the fact that they don't show to the world the trades that they're going to do before they trade them should be an advantage to the investors in the fund. The
Well,
fact
and go ahead.
the
Excuse me.
fact that they do this systematically is why, when you look at the exposure to the factors over time, it's stable. There's nobody behind the curtain second guessing and saying, I think small is out of favor this month. We're going to go a little bigger, and value is it's the wrong time. We're going to sit in cash for a while, and quality maybe that'll be a next month. There's nobody doing that. If there were, it would show up in the numbers. And the fact that it doesn't show up in the numbers tells me that this is essentially an index fund that's a private index. It's run behind the scenes. And that's why it's 25 basis points. If there was somebody, doing a whole bunch of sophisticated black magic behind the scenes, it'd be a lot more than 25 basis points of expense. So, yeah.
Well, and the fact that they look at all of their companies daily, they run this
Right?
information daily, and so if you compare it to the Russell 2000, where once a year they go in and correct to make things right, and Avantis, why would we want to wait a year if something is failing by whatever definite, however you define failing? Why let it go for a year or 9 months or 6 months? Do it now. And that is a part of what they do. And because they're an ETF, their turnover appears to be very, very low at 7%. And I think that is just because of the nature of how ETFs work. If they were a traditional mutual fund, I think they would be considered to have a lot more turnover. Daryl, you're certainly welcome to weigh in here if you got anything on your mind, a question that pops up to you.
Yeah, I think this might be a time to mention the fact that a lot of these small cap value or small funds or ETFs or indices, they have their own rules for what determines membership or determines eligibility for membership in the class that they're attempting to represent. And those rules are different from one fund to another. And one set of rules is what you just mentioned. There are others that other funds and indices use that make their component different. So a small cap value fund A is different than a small cap value fund B or C or D or anything else. And so, and this is where Chris's work has such value, so to speak, is that he goes in and he looks at what the performance is for different funds, not just what the name of the fund is.
Yeah.
And so I think that's maybe an important point that people should realize, is that just because something is named small or large or blend or value or growth, it doesn't mean that it's the same as everything else that might or might not have that name in it.
And by the way, I looked at DFA's ETF, small cap value, and Avantis, and I looked at the 25 largest holdings. Now they're not going to have a whole bunch of anything because they've got between 700 and almost, I think, 1,000 companies. And so they're going to have small percentages of a whole bunch of companies. But the fact that I looked at the biggest 25 companies in each, and I don't think there was any duplication. It makes me think, because DFA is so academically driven, and Avantis is academically driven. I think owning both of those funds is okay, because what it's going to give you is two funds that are trying to do very similar things, but you're going to have more diversification by owning both of those. And in looking at the returns of these two funds since the DFA ETC, we've had the DFA mutual fund for small cap value around since 1993. So there's plenty of history at DFA managing small cap value. And so when we look at their fund that's been around during the same period of time that Avantis has been around, the returns are very similar. Now, I can't speak to all of those things that Chris would look at. And maybe at some point after the first of the year, when Chris goes through his analysis, maybe he'll even take the time to share with us the subtle differences between the DFA product and the Avantis product. I think that would be a good lesson for us all. And I think it's probably something he does anyway. Is that fair to say that you're going to do that analysis when you decide which one you're going to pick?
Yeah, it's just a question of how much work we share, and how much we can do without confusing people.
Yeah, that is a problem around here, is it? That I'm responsible. I'm in charge of confusing our students.
Director of confusion.
How am I doing, by the way? Yeah. Okay, let's take a really easy question here. So J.L. Collins recommends we put all our equity investments in the Vanguard Total Market Index. And Warren Buffett says the same thing about the S&P 500. If you had to choose one, which one would you recommend? What do you say, guys?
Well, I'll go first, and then Chris can correct me. I'd put it in VTI because it's more diversified than the S&P 500. That's all.
Okay.
If you want to make a bet that maybe the additional volatility would pay off, then do the S&P 500. But
why do you think that the S&P 500 will have more volatility?
It's more concentrated, right? It's got fewer stocks, probably. It's in a specific asset class, large cap blend, more or less, as opposed to VTI, which has many more stocks and in more asset classes, although the weighting in the other asset classes is probably not that great. But that's my 2 cents.
Yeah, no, that's great.
That's probably what it'll make you, is 2 cents.
Chris?
Well, historically, the difference in the returns between the S&P 500 and VTI are very small, because the VTI is dominated by the large caps. Being a cap-weighted fund, the rest of the other 3,000-4,000 stocks that are in there just don't move things very much, because they're not very big in comparison. So at a return standpoint, there's not much of a difference between the two. And I think at a behavioral standpoint, there's an advantage in owning VTI in that you own a little bit of almost all of the companies that are public that you do business with. And that may be, from an educational and a psychological standpoint, useful. Because as Benjamin Graham used to say, if you own the total, I think it was Benjamin Graham, if you own the total stock market and somebody comes up to you and says, what about company XYZ? You can just kind of confidently nod and say, oh yeah, I have some of that, right? And so there's a little bit of psychological advantage there. But in terms of meaningful diversification, they both give you basically exposure to the market risk factor and nothing else. So if you really want additional diversification, I'd take a little of your portfolio and throw it in small cap value and put the rest in the S&P 500. Because when you own VTI, if you're thinking you're getting diversification, you're not. And the reason is that the small stocks that you own are offset by the large stocks, and the value stocks are offset by the growth stocks. So if you think that in owning VTI you're getting meaningful diversification, I would do it differently. I'd take the S&P 500 and add a little bit of small cap value, because now you have exposure to more attributes that are going to move at different times and thrive in different economic conditions and have earnings growth that varies from one another, and you're going to get a higher return per unit of risk. Yeah.
And if you look at VTI, the part that is not large cap blend is about 15% of the portfolio. So basically, if you bought the S&P 500 for 85%
Hmm. Yeah.
and small cap value, you'd have something cooking that could maybe add an extra 3/4 to 1%. Do you think, Chris, from the
Yeah,
studies you've
something
done?
like that. It's you,
Yeah.
you know, you're talking about 15% to 3%. So what is that? Half a per. I'd be confident in saying 0.5% in expected return. Not that you get it every year, but
Yeah.
yeah. And if you do it as a true buy and hold investor and you just let it sit there and you don't rebalance every year,
Mm,
it'll probably do even better in the long run. Yeah.
yeah, good point. Uh, and also another possibility is not to use the S&P or VTI, VOO or VTI, but to use AVUS, because AVUS has doubled up in its exposure to small and its exposure to value. It's still a total market index. Uh,
But it's a smart total market index, where VTI is a dumb total market index. And by dumb, I just mean it's making no choices at all about what parts of the market historically have delivered higher returns or not, where AVUS it takes advantage of the fact that we know that small cap growth historically drags things down, and so it filters that out and it shifts you in a direction away from this historically troubled part of the market. Yeah.
all right, well, that's great. That leads right into another question I had here from somebody who was asking about a something other than the international total market index at Vanguard. Is there something better people could use? And this comes up again with if you look at the target date fund at Vanguard, it is made up of the equity portion of the total US market and the total international market. And so if we wanted to help people, it seems like if we could replace the total market US and the total market international with something better in both cases, we will have helped them make a difference in their financial future that could be meaningful. So what do you say about something better than the Vanguard Total Market Index?
Well, there isn't an exact replacement for you're talking about VT, right? Which is the world, the global. Uh,
No, it's the um, well, the fund is the Total Market International Index.
is that
And I don't
VXUS?
remember, it is ex-US.
Okay, VXUS, which I think does include emerging markets. So
Yes, it does. Yes,
Yeah.
it.
So with this footnote that I'm going to ask you to go get emerging markets on your own, then what we do in our best in class recommendations is we recommend the Avantis fund AVDE, and Delta Echo. So AV Delta Echo. And the reason we do is that it is very similar to AVUS, but for international developed markets. It doesn't include the emerging markets, but emerging markets are a small part of the international ex-US markets anyway. So you could add that in with a separate fund. And the same principle applies internationally that does in the US. If you looked at a total market fund for international developed markets outside the US, it would perform very similarly to a top 500 or a large cap blend fund because of the cap weighting. So I would say AVDE is a good choice there. Yeah.
But they're going to have to do the emerging markets on their
Yeah,
own.
they'll have to add emerging markets separately. And
Probably 10%, 15% of that.
I mean, your recommendation in the ultimate buy and hold portfolio has always seemed prudent,
Yeah.
which is, yeah, it's 10% of the total portfolio.
Okay. And the emerging market fund you would recommend?
I think we're using
AVE
another
is
Avantis fund these days, AVEM.
EM. Yeah.
Yeah,
Okay.
just double checking that. Yeah, So we have Avantis Emerging Markets AVEM. That's our recommended best in class. And Paul, in your implementation of best in class in your own portfolio, and Daryl, I think in some of your back testing of the ultimate buy and hold, you actually divide the emerging markets into three parts, right?
Right.
And we have recommendations for emerging markets value and emerging markets small
Yes.
cap blend where somebody could do that if they wanted to. They could bring in they could divide up their emerging markets into those smaller slices, and try and extend the exposure they have to small in value into the international markets. It is more expensive to get your tilts to small in value internationally,
Yeah.
but if you want to preserve that kind of a tilt, you could do that.
Very good. So we had another project here today. I am such a fan of Ben Carlson. I don't know if either. Do you guys read Ben Carlson daily by chance? Anybody? No?
I listen to Ben Carlson weekly, at
Oh,
least.
you do.
I do
And I don't.
occasionally.
Um,
I do occasionally.
yeah, I just I don't listen to podcasts generally, but I do read his articles every day, and he had this recent one I thought was very good about some things I don't believe about investing, some things I don't believe, and I liked the list. And what I thought would be interesting, I will read quickly his one-liners that make up his list without all the explanation because it's pretty obvious. But I would be curious whether there are some things you don't believe about investing that I suspect a lot of people do. He says, I don't believe there is a sole way to invest. He says, I don't believe anyone has the ability to predict what's going to happen next with regularity. I don't believe politics should ever play a role in your investment decisions. By the way, I didn't know this, but in the article, he shows the total returns from the past four presidential election dates. And in 2008, the return was 14% annualized. 2012, 14% annualized. 2016, 15% annualized. And 2020, 16% annualized. So um, people who have shied away from being involved in one or other president in terms of the market have historically made a mistake. I don't believe investing is ever easy. I don't believe there is a perfect portfolio. I don't believe you should make investment decisions based on what Warren Buffett is doing. By the way, Warren Buffett is acting very bearish. And I don't believe you need to outperform the market to achieve financial success. I don't believe buy and hold ever truly dies. There are announcements that it has died many times in my 60, almost 60 years. Every time we go into a big bear market, somebody is predicting that buy and hold is dead. I
So
don't
that's like when they say that small cap value is dead, or remember equities died back in the, what was it,
Yeah,
70s?
that's
Yeah, they
right.
were
Yeah.
dead. They were gone.
The death
Sorry.
of equities, front
Yep.
page, US News and World Report, I think. I don't believe following the news makes you a better investor. I don't believe risk ever goes away. It's just a matter of choices. And that's what he came up with. And I just wondered whether you two have something that you don't believe in investing that's meaningful.
I have one or two, and they may be just derivatives of something he said, but and maybe this goes along the well, says I don't believe you have to do everything right as long as you don't do too many things wrong. And that is not original, by the way. I can't remember who said it, but
Warren Buffett.
yeah, well, okay, there you go. So, but I think it's true because I've done a few things wrong, and I'm happy with where I am. The other one is that I don't believe you have to be perfect when you're executing your investment strategy. Close enough is good enough most of the time. So you don't need to go for the last little 0.010% of return, or make sure that your asset allocation is perfect to the nearest hundredth of a percent. Close enough is good enough. If you look at
So
that,
so let me
those
ask
are
a
the two
question.
that I don't believe.
Let me ask a question about that, Daryl. There is an amount. I don't know. It could be any number of numbers, but there is an amount that is actually gets my attention. Certainly a 0.5%. If I can add a 0.5% over a lifetime, even as short as my expected life, I would take steps to make an extra 0.5% for the people and the causes I leave behind. Um, but
Sure, but you don't
how,
have to, and you probably will be fine.
no, that's right. But it still begs the question, at what point should an investor, J.L. Collins, smart guy, wonderful person, helping millions or at least hundreds of thousands of people, and saying basically all you really need is the total market index and just the US. You don't need that international stuff, just US. That's all you need. And so somebody comes along and says, but JL, if they would just put in 20% small cap value, it could add 1% compounded over their lifetime. And it's pretty simple to do that. In the whole scheme of things, the hourly reward in your lifetime for adding small cap value to total market index is the hourly wage is probably maybe $200,000 an hour or something, because it doesn't take much time. So what
I have two
is,
comments about that, Paul.
yeah,
So who's this someone who said, "Hey, JL"?
what do you mean? Who,
Anyway,
I
yeah,
say,
yeah. Who would
say,
that? Who would that be? Yeah, that would be you, right? So, so the other thing though is this goes back to one of the things that Ben said. there isn't a perfect portfolio. He doesn't believe there's a perfect portfolio. So you're trying to and you're right. You can add incrementally to your return, but the first step is to invest. And if you do that,
Right.
you're 90% of the way there. And so now we're just talking about what happens at the margin. And this goes along the lines of what I was talking about is you don't have to have a perfectly executed investment strategy in order to be
Yep. Got
good
it.
enough.
Got
Well,
it.
and just look, Paul, at how much time you, me, and Daryl spend trying to teach people how to become effective buy and hold investors of small cap value. I think JL looks at that and goes, A, I don't know that I don't want to put all that time into it. And B,
It's true.
I have other things I want to teach my audience. I've got
Yeah.
so
Yeah.
it's kind of it's a question of who you're speaking to and what they need. I mean, the fact of the matter is, for a very large part of the population, a target date fund may be just fine.
Exactly.
It may get them enough, and enough is all we really need, right? And were they to try and get fancy beyond it, it might actually cost them if it exceeds their risk tolerance and ability to stay the course. So,
Causes them to change
just
their strategy.
answering your question, Paul, the the truth I would add is that, and you and I talked about this the other day, and we may do a whole podcast on it at some point, but I don't think anybody invests in any of these model portfolios for a lifetime. And that would be true for, uh, two funds for life, the ultimate buy and hold, the Bogle and Buffett recommendations. I think
Yeah.
everybody's investing journey in life just has too many twists and turns and too much history in it. And even the teachers have complexities behind the scene that are a product of how they got to where they are and where they're going that mean that, it's fun to have these teaching examples, but life is messy. And even the teachers tend to follow something different than what they teach.
And my hope is that the students at Western Washington University will come closer to doing what we would think they should do than people who don't get that extra little kick in the behind educationally to get them headed in the right direction. But you're right. I mean, I'll just make one point. It happens all the time. Somebody will say, Paul, you guys, and they do mention you guys, they mention the work that you guys are doing, and they'll say, you guys are helping me out so much. I really like what you're doing. And then I'll just ask a couple little questions to get a sense of what they're doing with their with their portfolio. And it has sometimes almost nothing to do with what we teach. And I have to laugh because yeah, we spend a lot of time trying to get them to see the light. So okay, any more? You guys come up with anything else? I got one. Um, I don't believe people when they tell me how they've done in the market. I have spent a lifetime listening to people. In fact, one of the joys of being an investment advisor is that you do get to see, like a CPA gets to see how people have really done. And very often what they do remember so vividly, there are two things they remember with couples. One, and it's typically the male, remembers the stock that they made the most money on. They remember it so well. And the spouse, who wasn't the one, the female normally, who wasn't the one pulling the trigger and making the trades, would say, remind her husband of that she told him to buy Microsoft. And in the Seattle area, typically Microsoft was the story, and he didn't. And she has never let him forget. So the memories people have about their investments, um, and in fact, We know, and again, this is not a political statement, but we know that people do not remember what their life was like 4 years ago and what was going on that made any difference to them because we are so good at making up stories about where we are or where we were, and that's just human nature,
You
which
know,
is
the
one of
story,
the go ahead.
yeah, the stories of financial loss I find more believable.
Yes.
People will tell you about the mistake they made selling out at the wrong time or losing on a bad investment, and I think those are more believable because they're usually hard won.
Yeah, yeah. But I will tell you, most people do not actually understand the lifetime cost of a mistake. I mean, even that little bit that they pay for a load fund and what that really costs them. Their minds don't think like calculators and compound everything. Um, I would say that this one about I don't believe following the news makes you a better investor. And the studies also say, or being very smart. It turns out that being very smart does not help you make more money. That just sounds so counterintuitive. But the reality is that indexes are going to probably make more money than most smart people will.
I did have a thought though, as you were talking about the people who you talk to that follow our work and then have a portfolio that's different. And that's that I think the most important thing we teach is buy and hold investings. So it's buy right, hold tight, don't peek. And I think the fact that they find value in our messages, it's probably that. And sometimes people's portfolios are a mess, partly because of that. I know for myself, I really hesitate to trade out of things, even if it's to rebalance or get my portfolio in the right shape, because I don't want to pay the taxes, I don't want to pay the fees,
Yeah,
I don't
yeah.
want to make behavioral mistakes. And so, it may be that their portfolio doesn't look like ours, but that their behavior is helping them out. And that's probably more important.
Good point. Can you leave that in, please? I like that. That's good. Gentlemen, thank you as always, and certainly a really heartfelt thank you to all of you who keep coming back. When I read that somebody has been to our site and they've gone through almost all of our articles and podcasts, I have my first thought is, oh my God, I'm sorry. But the other thought is, and it's real, we are so happy to be able to help people do better with their investments. We're the first to admit we don't know what tomorrow will bring. We don't know what the next decade will bring, but we do look at a lot of numbers from the past. And I honestly don't know anybody who is well there. I mean, there are academics who are digging deeper than we are, but I can tell you for people out doing the kind of thing that we're doing, uh, I think we're doing a good job of looking at the past and finding information that can help you. And I hope you keep coming back, and I hope we keep helping you. Thank you and good luck.
How can I be wrong? I never make any predictions.
That's